Every year, right about this time, money managers do the same thing. They start doubling down on their best performers. Then they tend to hold those stocks through the end of the year. They like to show that they're winning. Sometimes the process doesn't pan out. Last year, the Fed threw a monkey wrench into the gears, caused a market-wide meltdown. But usually when hedge funds and mutual funds anoint, that's the word I like to use, their favorite winners going into the fourth quarter, those stocks keep winning until the big boys take profits in January. Which brings us to the big question. Who's most likely to be anointed by Wall Street here? When you look at the S&P 500, one name stands out above all others, and it is a surprising one. You know who's leading the whole, well, it's not really that shocking here. You know who's leading the whole index? Chipotle. Do you know that this is up more than 90% for the year? In fact, Chipotle's running away with it. The next closest competitor is only up 75%. Wow. It's like Secretariat. Don't get me wrong. I love Chipotle, the company, and I've been pounding the table on Chipotle, the stock, for years. Ever since they got past those food safety issues from a few years ago and then poached Brian Niccol from Taco Bell, bringing him in as the new CEO, well, I have been all in. But, geez, even I didn't expect a 90% plus gain. That's quite a run, especially for a restaurant stock. So how the heck did Chipotle become the best performer in the S&P 500? And more importantly, can it keep climbing, especially after Darden reported a number today that a lot of people thought was suboptimal? You got to remember, until the big health scares 3 years ago, this was consistently one of the hottest growth stocks around. When McDonald's spun off Chipotle in 2006, that's right, McDonald's owned it. It wasn't even a $50 stock. By the time it peaked 3 years ago, it was a $750 stock, all thanks to great food, terrific concept, and a turbocharged growth story. But then there were all those cases of E. coli, norovirus, spate of food safety incidents near the end of 2015, and they sent the stock into a tailspin. Now, I always tell you, it takes about 18 months for the American public to forget or get over this kind of healthcare scare. I mean, that's the collective consciousness. They forget the scare 18 months later. Now, we've seen it over and over and over again. We had it with Taco Bell. We had it with Jack in the Box. People have short memories. Unfortunately, just as Chipotle was getting over the first set of health scares, they had some more in the summer of 2017. Once again, the stock went in a free fall, ultimately bottoming at $247 in February of last year. Now it's more than tripled from those levels. Now, some of that is simply because of the 18-month rule. Chipotle lapped the latest food scares, and that's allowed their same-store sales numbers to surge. But I think a lot of it comes down to leadership. The board brought in Brian Niccol as the new CEO in February of 2018, and this stock has not looked back since then. Previously, he had been the CEO of Taco Bell. He was amazing there. He's had fabulous strides at modernizing the brand, bringing new traffic. Incredibly funny ad campaigns. Still, there was a ton of skepticism at the time. And Chipotle and Taco Bell, they might be both quick-serve Tex-Mex chains, but there's a world of difference between the high-end Chipotle and the cheap processed Taco Bell. And believe me, the Chipotle guys always let you know that. Turns out the skeptics were dead wrong. Brian has engineered a magnificent turnaround. We've been over a lot of this before, so I'm just going to give you some of the highlights. First, he partnered with DoorDash, that's a private company, to roll out a delivery program at 1,500 locations. The impact was immediate. Second, under Brian's leadership, Chipotle embraced digitization. Like many popular chains, these guys always had a throughput problem. They could only process so many people at once, so you often spend a lot of time waiting in line. Then you get angry, then you go to another chain. To solve that, the company started taking online orders, including mobile. They created a loyalty program to bring in more traffic. Can you believe how far behind these guys were? Third, Brian modernized the stores, giving them a better look. Remodeling is a great way to bring back customers who were scared off by the food safety incidents. What else? The company's been smart about tailoring its marketing to millennials. Over the past 2 years, Chipotle steadily released a series of new menu items, including lots of limited-time offerings, something else that brings in a lot of traffic. Now, a year ago was the chorizo. In January, they rolled out lifestyle bowls designed for people on specific diets, paleo, keto, double protein. And just today, which is one of the reasons why we wanted to do this piece, just today, Chipotle launched the holy grail of limited-time offerings. Behold the carne asada. Believe me, it tastes as good as it looks. I almost went for seconds. Now, the result of all these changes, Chipotle's been putting up some phenomenal numbers. 18 months ago, they were tracking up low single-digit same-store sales. The latest quarter, they gave you 10% same-store, 10%, handily beating the 8.3% number that the analysts were looking for. How about the earnings? It's like Chipotle's back to the old pre-health scare self, beating the earnings estimates quarter after quarter. In fact, so far this year, some of the beats have been truly spectacular. Looking back, the analysts who follow this thing severely underestimated Brian Niccol's ability to turn things around and restore Chipotle to its rightful place in the growth stock hierarchy, and the speed with which he could do it. As soon as the stock started getting some lift earlier this year, many of the analysts downgraded the stock and headed for the exits. Hey, I guess once burned, twice shy. Yeah, they couldn't believe that the new Chipotle had put its message behind it, its missteps behind it, and had a brand new message. They couldn't believe it. The company had another food safety issue last summer, but you know what? Brian Niccol has retrained his entire workforce to prevent future health scares, and this time it only took 6 months for the customers to start coming back, not 18. They heard about the new keto bowls in January, and all was forgiven. The analysts didn't see that coming either. That's one reason the company's been able to deliver so many monster upside surprises, because the estimates were just way too low. Now, though, that's changed. The analysts have been dragged kicking and screaming back to a bullishness. Their upgrades fueled the most recent leg of the stock's rally. These days, it's hard to find a piece of research that's critical of Chipotle. I mean, maybe that's actually a bad thing. When everybody loves a stock, it limits your potential upside. The biggest winners are typically surrounded by skeptics, people who refuse to believe. Gradually, those bears become bulls. That's how stocks go higher. I'm a little worried. Actually, it's probably the only fly in the ointment for Chipotle that maybe there are too many bulls and not enough bears. So what do we do with Chipotle now? If you don't already own the stock, it's no longer cheap, trading at 48 times next year's earnings estimates. I feel like you're chasing it if you're trying to buy it up here. However, if you want to own Chipotle as a long-term investment, you have my blessing to start building a position here as long as you wait for a pullback before you add to that position. It's kind of like a Costco, which I talked about at the top of the show. Best of breed is never cheap. That's why I wouldn't be surprised if Chipotle can keep climbing through the end of the year. When they report again in about a month, they'll be up against easy comparisons. As long as this market doesn't turn against the growth stocks again, I think there's more upside. I think it's likely, even with that labor lawsuit in New York City that caused the stock to get slammed down 5%. Jeez, are people skittish. But the comparisons will get a lot more difficult next year when they'll be lapping quarters with double-digit same-store sales growth. That's why it's a mistake to buy all at once. I think you need to come at this one carefully. You wait for a dip, perhaps to the 700s, and then you pounce on the rest. The bottom line, Chipotle's the biggest winner in the S&P 500 because it deserves to be. Because Brian Niccol, the CEO, has done a tremendous job of breathing new life into a tarnished but still terrific concept. So pray for a pullback that gives you a chance to do some real buying here. Although it's going to take a monster-wide market sell-off in order to be able to get that pullback. And you know what? I doubt you'll get it. Hey, let's go to Carrie in Pennsylvania. Carrie!
Thanks for taking my call, Jim.
Of course, Carrie.
My stock is B&G Foods, ticker symbol BGS. It's got a notoriously high BIG yield. Is the dividend safe? And what is your opinion of the stock?
I've lost faith in the stock, Carrie. I've lost faith. Too many misses. Not sure of what's really going on there. Company is way on the QT. I'm going to say ixnay B&G. I need to go to Dan in Maryland. Dan!
Jim, you recently recommended Tyson as a chicken supplier to the sandwich boom.
Yes.
But there are some pure plays in fowl lower in the pecking order, like Sanderson Farms. Is it worth flocking to, or is Sanderson not up to scratch?
No, Sanders is good. It's just a lot more expensive than Tyson. Now, as one of the themes of tonight's show is that best of breed, you have to pay more, and Sanders is very, very good company. Tyson's much more of a commodity play. But at 15 times earnings, which is half of what Sanderson Farms is, I like it. Notice after they reported that little bit of mix-up with commodity, the stock got hit and then came right back. That's the hallmark of an inexpensive stock that wants to go higher. Vince in Nebraska. Vince!
Hey, Jim, how are you doing?
I'm doing good. How about you?
Good. Hey, you and I spoke about 3 weeks ago about Red Robin Gourmet Burger. At that time, you recommended that since some analysts from Bank of America Merrill Lynch had downgraded the stock to underperform, to stay away from that. And at that time, the stock had dropped on that date about $30 a share.
Right.
Value Line has it projected in the 3 to 5 years at 50 to 75. Vintage Capital, an activist investor, took an 11% position to agitate for changes and offered a $40 hostile bid that the company turned down. The stock went to $35 a share after we spoke, and it's at $34.94 today on a close. If you endorsed Elliott's management's activist investor role in AT&T, why not RRGB now?
Because I think that because in the end, the company's just not that great a company. I don't know how you make it into a great company. I mean, you have to hope that they're putting it up for sale. That's not what they want to do. And I don't like to play hope. I'd rather own high quality and bet that the high quality wins. I'd rather own Chipotle. I'd rather own McDonald's. I would rather own Wendy's. I would rather own, well, geez, Darden, even down 5 today off of what seemed like a not great quarter. All right, I've said it before and I'll say it again. Brian Nichols' turnaround strategy at Chipotle has been so successful that even the bears are hibernating. If you want in on this S&P winner, remember the best stock in the S&P 500, build your position slowly. Wait for a lower entry point to buy the rest, maybe in the 700s. Much more Mad Money in. What the heck's happening in the oil complex? I'm offering the crude reality. We always like to use that term right here. Then, does your portfolio have what it takes to fight the unknowns in this market? I'll be the judge of that when we play MI Diversified. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.